Hey, let's talk about July's job numbers, Fed Chair Powell's comments at Jackson Hole, and the outlook for a recession in 2026. So the job market. Most economists say a healthy U.S. job market adds around 100,000 new jobs per month. Now in July, we only added 74,000 new jobs, and over the last 3 months, the average number of new jobs plummeted to around 35,000. New hiring is basically flatlining right now. Now last Friday, Fed Chair Jerome Powell said the economy is in a curious balance. Both job supply and demand are weak, but the overall unemployment rate is still low. However, the total number of people collecting unemployment benefits has been rising. As of August 9th, there were nearly 2 million people on unemployment, which is the highest level it's been since November 2021. So let's talk inflation. It's above the Fed's 2% target. Core PCE is around 2.6%, and the CPI is currently at 2.7%. Both indexes are trending up, and tariff-driven price hikes remain a concern. Now, most businesses have not yet started passing on tariff tax hikes onto consumers. However, most companies have been foreshadowing price hikes in 2026 if the tariffs remain in place. So what's the Fed to do? It's walking a tightrope. Lowering rates too soon could fuel inflation, but ignoring job weakness risks a recession. Now, Fed Chair Powell signaled at Jackson Hole that a rate cut in September could happen, but he also gave his usual caveat that it all depends on the upcoming unemployment report, which comes on September 5th, and inflation data that comes the following week. Now, regardless of Powell's measured comments, Wall Street and the markets are expecting a quarter-point rate cut in mid-September. Some people inside the Fed are cautioning against assuming a rate cut, citing the sticky inflation, but I fully expect the Fed to cut rates. The job market is trending down, which poses a larger threat to the economy than the nagging inflation, and inflationary risk could be quickly reduced if the tariff taxes were ended. So that's the current status of the job market, inflation, and interest rates. What does it all mean for 2026? So many economists are forecasting a significant chance for a recession if the current tariff scheme is continued. The weakening job market combined with these artificially raised prices are a perfect storm for a recession. The New York Fed, an economist survey, put the likelihood of a recession at around 33%, the IMF is at 50%, and JP Morgan Chase Bank's current estimate is 60% chance of recession in 2026. Now, recession means shuttered businesses and loss of jobs. Not good things. But it also means low interest rates. So if you're well positioned to weather a recession, 2026 could be a good time to make a big purchase, like a new car or home, as rates will inevitably fall as the economy cools. So for now, a weakening job market plus lingering inflation equals a high-stakes Fed decision in September. The silver lining for anyone planning on making a big purchase over the next 6 months is that rates will more than likely be lower then than they are now. So thanks for watching. We'll see you on the next one.